Okay, so here's the big question we're tackling today. It's a multi-billion-dollar one. Can a stock that our numbers suggest is worth maybe $4.20 actually trade near $60 just because the government says it's strategically vital? Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today we're doing a deep dive into MP Materials. We're using our record from November 10th, 2025. Look, the stock just had this huge rally, and our job here is to figure out, is this the moment to buy in strategically, or is the market, just ignoring some massive red flags?
Yeah, let's set the scene first. The macro picture is, well, it's a bit mixed, isn't it? Globally, things feel pretty risk-on this morning. Money's moving into tech. NASDAQ Q's up almost 1.5%.
But that global picture kind of bumps right up against the domestic one, which looked, frankly, a bit darker. We're getting these warnings direct from White House economic advisors saying the government shutdown could actually tip Q4 GDP negative. So if you're betting on a U.S. industrial company, you've got this pretty serious headwind blowing right at you.
Exactly. And that headwind is key context for MP Materials. The whole story here, it's almost purely geopolitical, wouldn't you say?
Yeah, it seems like it.
I mean, this isn't just about digging rare earths out of the ground. It's about processing them, breaking China's hold on that critical step. We need these for defense, for EVs, for advanced tech.
Right. That supply chain vulnerability.
That's what the government's focused on, and honestly, that seems to be what's propping up the stock price. It's that strategic premium.
Okay, but let's talk brass tacks, the actual money, Q3 earnings. Well, they reported negative 10 cents a share. Now, that did beat the street's fears, but their net loss actually got bigger, didn't it? Nearly $42 million.
It did. And what's really interesting, maybe counterintuitive, is that loss wasn't some operational failure. It was a direct choice. Yeah, they stopped selling to their Chinese customers. That was part of an agreement with the U.S. government, to keep the supply chain domestic. So they're burning cash, profit margins are negative. Our analysis, looking at their current financials, well, it points to a fair value around $4.20. That's the financial reality today.
Wait, so hold on. If they just flipped a switch and started selling to China again, they'd likely be profitable. Are we kind of penalizing the stock for doing what the government wants?
That's precisely the tension. The market isn't trading on today's profit and loss. It's trading on the promise of future government support, future domestic processing, future security, not the P&L right now.
Which explains why traders seem so split on this.
Totally. You see it everywhere. The skeptics, they're dug in. Short interest is huge, almost 15% of the float. They're betting this thing comes crashing down.
But the options market looks confused.
Yeah, massive indecision. The put-to-call ratio is basically 1-to-1, perfectly balanced at 1.04. But look where the action is concentrated. The $40 strike price. That seems to be the key psychological line in the sand for options traders.
Yeah.
A break there, either way, could get really volatile.
And we just saw some of that volatility, right? The stock chart looks like a battlefield.
Yeah.
It just exploded higher Friday, opened around 50.50, closed near 58.60, just boom.
A huge move, no doubt.
Yeah.
You have to zoom out. That spike happened within a much larger, well-established downtrend. The stock's still way below its 50-day average, which is hovering around, $70?
Okay.
And if you look under the hood at participation cues, cumulative volume, momentum indicators, they're still firmly negative. It suggests the bears haven't really lost control of the bigger picture. Think of Friday's move like a flash mob. Creates a lot of noise, looks dramatic, but doesn't necessarily change the underlying trend.
Right. So putting it all together, the strategic angle, the government backing versus the very real financial burn and the technical weakness, where do we land?
Well, our conclusion, based on the research, is a neutral stance, but definitely with a bearish bias.
A bearish bias, meaning you think that big jump was mostly
likely a short squeeze. Bears getting squeezed out, forced to buy back shares quickly. Doesn't feel like a sustainable rally based on fundamentals changing overnight.
So for you listening, what could prove us wrong here? What makes this bearish view incorrect?
Good question. 3 main things come to mind. 1, concrete new government contracts, real money flowing in. 2, just a massive market melt-up where everything goes higher, regardless of fundamentals.
The rising tide lifts all boats scenario?
Exactly. And 3, maybe their big Texas magnet facility comes online way ahead of schedule. That would be huge validation for their processing strategy.
Okay, key levels to watch then.
Keep an eye on that 50-day average near $70. If it breaks above that and holds, we'd have to seriously rethink things. On the downside, support is that recent low, around $50.50.
So bottom line,
MP Materials is a story stock. It's trading on a geopolitical narrative, a promise. Right now, it really feels like a lottery ticket that's somehow priced like a safe, blue chip bond.
That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.